Hi, welcome back to this, my first posting in 2019. As some of you know, I spend the first week of every year playing Moneyball, looking at the data, making my judgments on what they tell me about the future. And I'm usually wrong, but I still do it every year. This year, my first post is going to be about the overall market and especially US stocks. Let's face it, it was an interesting year, and I'm using the word interesting the way the Chinese use it as a curse. In bull markets, we collectively as investors, both professional and amateur, tend to get lazy. We get sloppy. We talk about risk, but we really don't mean it. We think every drop in the market is an opportunity to buy, and we believe in bromides like, hey, stocks always win in the long term. And that's not a critique of you, it's something that we all share. So markets send us reminders that those things are not true, that there is real risk in equities, that there's a reason we get an equity risk premium for investing in equity. And the last quarter of 2018 was a reminder. So let's take a look at 2018. It started well in January, but then in February we had our first mini breakdown. It happened over the course of a couple of weeks, starting with macroeconomic worries about inflation and then spreading into the tech stocks. Then stocks recovered, and they continued to recover through the summer. In fact, as you can see, the third quarter was a very good one. In fact, by September, on September 20th, stocks had hit the high for the year, and I wouldn't have blamed you if you thought it was going to be another good year, the 10th year in a bull market. Well, that was not to be, because the last quarter of 2018 was painful. Painful not only in terms of what it delivered as a stock return, which was a big negative number, but the volatility that came with it. It started with October, where we saw day-to-day swings and intraday swings that were wide, and the market was down over 6%. November, you continue to see the swings, but the market flattened out, and people heaved a sigh of relief that maybe the volatility was behind them, and they perhaps sighed too early, because in December, markets went into full-fledged collapse, dropping more than 9%. We ended the year with the S&P 500 down more than 6%, but it wasn't just the S&P 500. This pain, even though at different points in the year people pointed to different sectors. It was the tech sector, it was the FANG stocks, it was broad-based. It was large cap stocks and small cap stocks, tech stocks and non-tech stocks. In fact, even though the NASDAQ and the S&P 600, which is a small cap index, dropped more than the S&P 500 and the Dow, that drop is actually well in line with what you expect with other market drops. Riskier stocks do tend to drop more, and that is what you saw. So, in fact, it's, I think, unfair to blame the drop in 2018 on a particular sector, a particular group of stocks. It was across the board. So to give you some historical perspective though, if you count in the dividends we received, the returns in 2018 on the S&P 500 was about minus 4.23%. Well, that was a bad year. It was the first negative year in a decade, but before you get too caught up in self-pity, it's worth stepping back and taking a look at the longer term perspective on where 2018 falls in the larger scheme of bad years. So what I've done here is graphed out the annual returns on the S&P 500 going back to 1928. And you've got to do some backfilling because the S&P 500 has not always been around. So it's basically, but these are the returns on the 500 largest market cap stocks going back to 1928. And I've essentially ranked them from worst years to best year. So if you look at that listing, 2018 was a bad year, but it was the 21st worst year in history. In other words, there were 20 years which were worse than 2018. So why did it feel so much worse? Why do we feel as if we've been put through the ringer? I think there are three reasons. The first is we've had 9 good years. We've been spoiled, and when you get a bad year, it just doesn't feel like it should happen. The second was all of the pain was condensed in that last quarter, making it more nearer and more immediate, so you felt it more. And third, the drop was combined with this volatility, the up and down swings that made you feel like you were going through far worse. So if you're feeling terrible right now, perhaps you will feel less so a few weeks from now when things have settled down. So now let's take a look at where we stand. One of my favorite devices for looking at equity markets overall is the equity risk premium. It's the price of risk in the equity market that investors are demanding for investing in stocks. Well, the way I compute it is I take the current level of stock prices and I take expected cash flows, which I have to estimate, and I back out from it the expected return that investors are demanding, an internal rate of return for stocks. It's analogous to a yield to maturity on a bond. Once I get that expected return, I subtract out the risk-free rate, the T-bond rate, to get an equity risk premium. So price of risk in the equity markets, it's dynamic, it's forward-looking, it's surprisingly robust and captures everything that should affect stocks, growth and risk and interest rates and cash flows. So at the start of 2018, I computed this. I report this at the start of 2018. You can find this, one of my data updates from early in 2018, where I computed the equity risk premium for the S&P 500. The S&P 500 was at 2,673.61 at the start of 2018. Analysts were pretty optimistic about future growth, primarily because the tax cut had just happened, 7.05% growth, and the T-bond rate was 2.41%. With those variables in place, I estimate an equity risk premium at the start of the year of 5.08%. So that was at the start of 2018. Now, one of the old wives' tales about equity risk premiums is if you're in a developed market, the equity risk premium doesn't change very much over the course of a year. I used to believe that before 2008, but that's no longer true. The equity risk premium can change dramatically, as we saw in 2018, at least in two time periods. One was the first week of February and the other was all of October. And what I did during those periods was actually computed the equity risk premium by day to show you how much the equity risk premium will shift during the course of a few days. In October, for instance, the equity risk premium started at 5.38%, jumped higher, it was above 6% for a brief period before dropping back to about 5.76%. Over the course of a month, you saw the equity risk premium jump by almost 0.5 to 0.6%. That to me is a reminder that even in developed markets now, the price of equity risk can change. Now, of course, after the bad December we had, I decided to compute the equity risk premium at the start of 2019. Now, as you know, in December, not only did stocks drop by more than 9%, but people got increasingly pessimistic about the future of economic growth, both globally and in the US. And my inputs at the start of 2019 reflect those changes. First, the index now, start of 2019, is at 2,506.85, 6% lower than it was at the start of the year. Growth has dropped from over 7% to closer to 4%. That's a pretty significant drop on a year-to-year basis. Cash flows have remained surprisingly robust. They're significantly higher than they were last year, partly because you've had the trapped cash released by the tax law. Risk-free rates, the T-bond rate has risen, but not by as much as people feared it would. With all the worry about the Fed, the rate went up from 2.41 to 2.68%. All in all, if you put those numbers in, the expected return I get for stocks is about 8.64% based on the cash flows and the level of stocks, and the equity risk premium has risen to 5.96%. Just to give you a comparison, stocks are down, cash flows are up, growth is down, the T-bond rate is up, and equity risk premiums have increased from 5.08 to 5.96%. Now, at this stage, you're probably saying, what do I do with this? What does that mean? To me, the equity risk premium becomes an indicator you can use to ask yourself, am I comfortable investing in stocks? And the way to read the implied equity risk premium is you ask yourself, is that enough of a premium for me to invest in stocks given how risky I think stocks are? This is a personal judgment you have to make, but one of the ways I make this judgment is by looking at the history of implied equity risk premiums. So this is the implied equity risk premium going back to 1960. The average over the last 58 years is 4.19%. Remember, you want a higher premium if you want to invest in stocks, which 5.96% is well above the 4.19%. If you take the last 20 years, the average is 4.7, still higher. Last 10 years, post-crisis, still higher. In fact, if I look at the implied equity risk premium relative to history, stocks look more likely to be. In fact, there are only 3 times in the last 58 years where the implied equity risk premium has been higher than it was at the end of 2018. One was in 1979 after the hyperinflation of the 1970s. The second was in 2009 after the 2008 correction. The third was in 2011 after another correction. So basically, if you look at the level of the premium, stocks are more likely to be under than overvalued. Now, I'm of course aware that there are dangers lurking. When aren't there dangers lurking? The biggest danger, as I see it, is lower economic growth, perhaps a recession, causing even the low earnings growth I've used at the start of 2019 to become even lower. So I did a little what-if analysis. What if earnings growth turns out to be lower than the 4.12% that was being projected? I tried 3, I tried 1, I tried 0, I tried -1, -3. And you know what? the obvious thing happens. As my earnings growth declines, my equity risk premium becomes lower. But notice, even with a minus 3% compounded annual growth for the next 5 years, which would be a horrific 5-year period for earnings, my equity risk premium is at 4.31%. So if there's an earnings growth danger, markets seem to have priced it in already. There are other dangers. When interest rates could go up, the fear of the Fed always lurks under the surface. But remember again, for interest rates to go up, either there's got to be higher inflation or higher real growth. The Fed alone can't push up long-term rates. And in fact, it is incredibly difficult to see a scenario where you have both the recession kick in and higher interest rates. So think of this as an alternate scenario where there is no recession but higher growth and higher inflation. And higher interest rates by themselves are not bad for stocks because that higher growth also helps your earnings grow faster. You could have a pullback on cash flows. Remember that the trapped cash came back in 2018 and might not come back in as much as significant a magnitude in 2019 and 2020. I plan to look at the cash balances of US companies in a subsequent post. We'll see if cash has dropped off. But again, there is enough buffer built in here. Even if the cash payout drops to a sustainable level, the equity risk premium is 5.55%, well above historic norms. There are, of course, going to be crises. In fact, that's a given in the global environment we're in. There's Brexit that's going to play out to its messy end, and there's going to be the trade war, and who knows what comes out of it. And of course, there are going to be a couple of crises we don't even see coming that are going to hit us. Will any of those crises be large enough to explain away the 5.96%? I don't know, but I don't see them right now. The bottom line is, and I've always made this statement, which is it's better to be transparently wrong than opaquely right. And what I mean by that is I'm sick and tired of experts who try to hedge and say this could happen, but on the other hand, this could. I'm going to be pretty open. I think that stocks are more likely to go up than down. And as far as I'm concerned, I'm going to stay invested in equities. And if I'm going to be wrong, though, I think I'm going to be wrong because I'm underestimating the shock to economic growth, how much lower economic growth can be. So, and the potential for a crisis to be larger, a big economic or a political crisis to kick through. I would love to tell you that I'm going to keep my eyes open for this to happen, but odds are by the time I see it happening, it's going to be too late for me to get out of stocks and I'd have suffered some pain. But I view that as part of investing in equities. There's a reason I've been earning an equity risk premium for the 30 plus years I've been investing in stocks. And if the cost is there are going to be years like 2018 and perhaps 2019 where I have to bear the downside, I'm willing to live with it. I hope you are too. Thank you very much for listening.